All right. Good evening, guys. Ken of Tortoise Capital. This is the nightly strategy podcast for December 28th, 2020. Had a little trouble connecting to the network. Thanks for your patience. All right, let's start with the 30-day look-back period. So we made a new 30-day high today, a 10-day high, and an all-time high up here at 372.5. It was probably the same height here, but the fact that it made it today again, I'm going to give it credit. 2.8% down to the 10-day low, made 5 days ago. So that's going to be the frame for a while, 2.8%. The 30-day high made today and the 30-day low made about 25 days ago at about 5% 30-day range, which is not very much. That's starting to get compressed, and we see that reflected in the compression of the Bollinger Bands catching up to us. We've got almost a 20-day range in a pretty tight range right there, about as wide as the 10-day. So this is feeling like a sideways quiet channel has now developed. We've had one previous run to the top, which got rejected, one sharp sell-off, which was quickly rejected and stabilized. So right now, this powerful cluster right here in the middle really is the normal. And so today, we had a nice big gap up, a false breakdown, a nice little recovery. And for all the fireworks, it turned out to be a pretty narrow range day for the first day back. The sell-off quickly was bought and returned. It was a low volume day. So maybe this is just holiday trading going into the new year. We'll see. I'm expecting a test of both of those price levels tomorrow. I think we'll see price both north and south of that tight range, so I'll be ready to play a breakout in either direction. I'll be looking for the relative strength leaders, the story stocks like Tesla, QS, Palantir, CRISPR. Let's see that Pulse, the storage, Pure Storage. I would not be surprised to see that there was some strength in the FANGs. So that could be a place to go. The S&P was strong. The Russell, which had been outperforming, underperformed today, which was a bit of a surprise. So we'll see if that's going to be a buy on dip opportunity and rebound. That would be my expectation tomorrow. I've added a new symbol to my stack, the ETF LIT, which is a lithium commodity and a battery company focused. Their fourth highest holding, a 5% stake of that, is in Tesla as a battery company. And so this is a pretty carefully focused ETF. It's had a nice run over the last 6 months. I don't think it's liquid enough to trade intraday, but on a swing basis, that could be an interesting alternative to trying to pick individual winners in the electric car companies, because there's some strong commodity holdings in there, and some of those are foreign holdings that are difficult and thinly traded, and so lit might be a way to get some exposure in there to overcome some of those shortcomings. But I think the main point of today was this very tight, this sideways quiet channel in here that I've colored in the dragon. Today just feels like an anomaly in a test. If that gets rejected, it comes back into 368. If it breaks out, it gets to Z2 pretty quickly in 374. So I think there's room for a tactical trade tomorrow. That's what I'm going to be looking for. All right, let's just take a quick look at the sectors and then a handful of trades for today. All right, so the S&P finished the day at 0.86 on the strength of that gap. To the downside, the downside of it in the U.S. indexes, diamonds lagged at 0.66. Treasuries were flat at 0.04. The Russell was down a third, and the Qs were the only thing that outperformed the S&P today at 1%. Let's look to the downside. So the downside sectors today, finance underperformed at 0.41, Mexico and emerging markets at 0.33 and 0.3, healthcare at a quarter, materials and Brazil were the first in the negative zone today at minus 0.4. The VIX showed no sign of fear today, off a half. Energy was down 2/3, oil down 1%, oil exploration down 1.8, biotech down 2.37, clean energy down 2.5, and then a bunch of the story stocks in here. We'll see a trade series in U.S. Steel, Cliff, Neo, Virgin Galactic was a great short today. Palantir gave back a lot. So lots of volatility in the focus stocks that we look at. I take so ARC Genomics is that was down 1.4. I take that as a positive sign that it's down 1.4 when the broad biotech sector is down 2.4. So I actually take that as a sign of relative strength in the ARC. So that's a long-term holding for me, and I will not be persuaded out of it. To the upside, so the S&P again was up 0.86. The sectors that outperformed are just a couple. Japan up 1%, S&P Tech up 1.13, and that was slightly better than the Qs at 1%. The FANGs were up 1.6, silver up 2%, and LIT, which is that lithium ETF and battery ETF, up 2.7. The big winners today, Nikola up 20%. There was an intraday trade available in that one. Bitcoin Trust 11%. Ethereum 4%. Apple and Amazon leading the FANGs there at 3.5%. Apple just feels like a strong contender. Watch for more language about Apple getting into the electric vehicle business and being a strong competitor and a real threat to Tesla. My spider sense is that they're a long way from getting into that business, and that's not something that you can outsource to third world manufacturing. So that's not the same as them getting into the entertainment and software business. I still think that's a lot more hype than reality. They have less manufacturing excellence than Tesla. What they do have is a really strong vertical supply chain and horizontal support and reputation, and there will be fanboys that will pounce on that, hoping to get Apple to behave the same way Tesla is. The difference being is that they actually have a balance sheet and actual sales that Tesla does not. So I see it as dilutive to Tesla's strength in that sector. I think it's more smoke and mirrors and noise than anything substantive yet. But that's going to be an interesting development to see where they want to be in 10 years and what they do with acquisitions and that great big pile of cash they have. They've been pretty savvy managing, global supply and manufacturing chains and handling COVID maybe better than any large company. So I wouldn't put it past them to become competent in that manufacturing space. But man, that's a really brutal business, and you have to be able to deliver product. If an iPhone malfunctions, that's just a warranty issue. When an automobile malfunctions, you're talking about lives and liability, and really intensely regulated sector there. Tesla had a Model S, I think, catch on fire today. So it's a really that'll really be an interesting test of their strategic vision. So Apple is on the board. The other companies that did really well today, Alcoa, Simon Property Group, McDonald's, Walmart. So there's a lot of strong companies in there. Apple, Amazon, McDonald's, Walmart, Microsoft, and Wynn. So, 5 pretty good names rocking steady in there. And Microsoft and Apple, I think this is going to be their year, especially this first quarter. I'll be watching them carefully. I think they're undervalued. All right, I want to jump to the daily report, and then we'll test our connection for some sample trades from today. Shapes. Yeah, already. There we go. All right. Let's let that come up on your screen. Okay, so we are in bullish normal conditions. We are back to overbought on the 2-day NDX and above average 10 and 30, and then still significantly overbought on the long term. So this was a good 1-day rebound, but most of that gain was in the gap, so it wasn't really available unless you're in the pre-market with futures. I should also say we did a presentation on the Forex after action review and the annual review I did with Dr. Morrison. I think those guys are knocking it out of the park. They had some really impressive numbers, and I've given them some challenges for the year ahead. But I think they are pretty solid. I think they're in better shape now at the end of the year than they were at the start of the year, and they've been solid all year. But they've got some real momentum going into the new year. Let's see. The risk index is still risk off at 0.983, so we're still vulnerable to that downside spike. But you will notice that we have turned the corner and are in the spring. Yeah, let's get a little zoom in on that thing. Yeah, so let me zoom in on that. and as you can see, we've turned that corner, moving up into the spring, and that dip into the winter was so shallow that this could really make a nice move if it gets above that zero line. And we'll see how that shakes out. My only concern here is that we've got kind of a low volume, holiday trade going on right now, so I'm a little reluctant to put too much store in that yet. But we'll see how that goes. But an interesting turning point already. Today's follow through, in view of the negative news from COVID and the different mutations, is really was kind of a surprise to me today. The gap up was a surprise. The lack of follow through was even a bigger surprise. I would have thought there'd have been more opportunities for sharper directional trading today on a holiday with less volume, but there didn't seem to be much gamesmanship going on. When we're this overbought, there's not going to be channeling and overreaction signals. The min pains are instructive. There's Apple and Microsoft, Travelers and Coke inside there. And then the max pains, still problems in Boeing and Intel. The whole energy sector was just weak. I should include, 4 out of the 5 are in the energy sector: natural gas, oil exploration, S&P Energy, and Global Energy. ConocoPhillips in the S&P 100. In the Dow 30 tactical, just a handful of dojis today. A couple 3 channelings. We would want to look at Boeing, which is instructive. So that's a channeling. It's also a triple screen and tests out at 4.4 to 1 on the auto framer. So we still have quite a few symbols that are testing well on the auto framer. Chevron in the energy sector is a channeling and is 3.3 to 1. Honeywell, which I like, is a triple screen and also 2.8 to 1. Intel was a doji today and is at 4.3 to 1, so I kind of like them. That's a stealth trade setting up for us. Let's see, the final one I guess we'll look at is Verizon. 2.9 to 1 on the auto framer, also a channeling. We should note that, United Health and Visa all had breakouts on their 10-day NDX. And Apple had no other signals other than to say breakouts on the 10-day, 1 month, and 3 months. So we've been pushing the Apple narrative here for a couple of weeks, and it's really marching along. It's really standing out. The only thing close to it really has been Disney. Which has been dominating on 1 day, 10-day, 1 month, 3 months, and 6 months. Didn't have any breakouts, but that's really been the other really strong story stock. I guess you could say Goldman has been strong among the price change percentages. What I'm looking for here is all these green boxes, and the more green boxes, the better, because that we're looking there at the price change over those look back periods. And those that are in the green are more than 1 standard deviation above the peer group in the Dow, whereas all the red boxes are the ones that are more than 1 standard deviation below the Dow 30 average. So these are where the relative strength performers are showing. When you see a lot of green boxes in the price percent changes and green boxes in the NDX, what you have are symbols that are also breaking out of key trading ranges, and that's why Apple really just gets my attention right now. All right, in the ETF 30. Next up, we have lots of dojis there today. We have one channeling signal in energy. Take a look at that here as soon as it comes up on your screen. Yeah, and so that's a channeling, and then also 2.8 to 1 on the auto framer, so that looks attractive. We have more ETFs that have broken out, though, than in the Dow. So we have Diamonds had a nice, big, strong move up. A 10-day, 1 month, 3 month, and 6 month improvement. The NASDAQ also broke out on those. Obviously, the triple Dow would also break out. Finance, big breakouts. And the S&P tech. So that's really showing you where the strength in the moves were today. Finance and tech. Only the Russell underperformed today. So I'll be interested to see if there is a follow through or a catch up trade on them tomorrow, because they have been outperforming for about 6 weeks. And I would have thought today would have been their day. And they started off strong, but didn't follow through. So lack of traders' commitment. It may just be that they feel that they're already fully valued. So we'll see how that goes going forward. All right, in the auto framer, still some good defensive plays on the list, better than 2 to 1. I would highlight Honeywell and Energy. I think when the S&P is on this list, that just tells you this is a market condition that is very, it's tightly compressed and has room to run. Boeing and Intel, obviously interesting, at better than 4 to 1. And in the framing data boxes, you see all the mechanical price levels for those of you looking for that. Brazil, I like them at 1.7 to 1. Not, I would prefer 2 to 1, but they're in the wheelhouse. Daily squeezes. I would have thought there'd have been more of these, given how narrowly compressed the trading ranges were today. It's useful to notice just how tightly compressed the S&P is. It's almost at 4 to 1 on a daily squeeze and a breakout. So again, let me just highlight this opportunity because I see this as a legit trade frame for tomorrow, especially in the S&P. So what that 3.9 to 1 means is this: if you take the we're looking at the range stat divided by my risk, okay? And so the range risk is $1.62, and the average range has been $3.50, and the range risk from today was only $1.62. So it's about half of, well, it's more than, it's less than half. Today's range was only 42% of the average range. So we take a look at the range divided by the average range, and when it's 0.42, that just tells you that if this was the average range, then today's range, like this little doji that we had today, was only 40.42 of the average range. So we treat the average range plus one standard deviation of the last 30 days of range. That equals a range stat. That's our term for the maximum reasonable intraday move. So on the setup, what we have is a nice little doji like today. So we put a trade box around that. We say, well, if it breaks out of today's high plus a nickel, and we just automatically go long here, and if we use the daily low as the 1R execution risk, then if it makes just a range stat move from here to there, then the ratio is at 3.9. We would get a 3.9 R gain versus the 1R risk if it just makes a range stat move. So what that tells you is that without getting into the finesse of intraday trading, if you just get a signal that like we hope that it opens inside this range here between the high and low today. So we want an inside day open, and then if it breaks out, you just automatically go long at the new daily high, and then trail it with a full range risk. In this case, $1.62, and then if it just makes a range stat move, you get a 3.9 R potential frame. That also works on the downside, because when you have a nice tightly compressed doji today, like we have near the all-time high, which was made 5 days ago, and then it sold off, and then there was a gap up and it tested. So you've got this double top and a tight range compression. So if it breaks out, it's at all-time highs. So a breakout to all-time highs could yield a range stat move. You don't even have to argue strenuously to believe that. But also, if it breaks down, it could close yesterday's gap, and then that would generate momentum. So you can get a strong argument for a range stat move as possible in either direction tomorrow. Well, that's what this daily squeeze really is. It's simply being ready for a large intraday pop. These are targets that have become compressed on a daily basis where the range is less than 0.7 of the average range. Right? So you see that really everything from UNH and above was 70% or less. Honeywell was at 55, half of a daily average daily range. The Euro-Asia blend at 0.54. So of all the symbols we track, the S&P had the tightest compression of all. That tells you how low volume or low volatility that was today, right? These other ones don't quite test out at 2-to-1. That's why they don't have the dark green light. But I like putting them in there because XLK, healthcare, those are all so close that it's worth knowing that they're almost in the wheelhouse. But just notice how tightly compressed the S&P is at 3.9-to-1, whereas technology, which had a good day today, was 1.9. So that just tells you on a relative basis, if this was the S&P's relative move, XLK was at 0.67. So it had a relatively larger directional move today. Not surprising, because that was the winning sector today. So the real compression is in the S&P. So if it breaks out, especially when it's that tightly compressed, this will act like a spring, and now you have an increased probability of a range stat. Well, what does that mean? This is the working definition of S&P being in a critical state. What's a critical state? By definition, a larger than normal probability of large move, meaning larger than average, either direction, in a short period of time. Those are the three elements that make a critical state. This happens to be one of the trade frames and strategies that we can use to find symbols that are in a critical state. So what we're saying is that tomorrow there's a greater than normal probability for the S&P to have a one-day directional pop. This says nothing about any follow-throughs on this chart. It simply says that compared to its average volatility, today's compression was so tight that if you get a range stat move, this could really be awesome. Now, what makes the S&P especially interesting is that it's near that 10-day high. It's near the 10-day high, the 30-day high, and the all-time high. So when it's poised right there, any breakout has no resistance overhead. So that could free it to run and get some momentum to the upside. By the same token, it is so decisively overbought because of the gap up and the strong finish that if it just goes back and tests the 10-day low, like a sell-off from oversold conditions, you could see a momentum trade happen in there. So this is one reason to be interested in the S&P, just because it's at the top of the stack and has 3.9 to 1. But there's a second reason. The second reason has to do with trade location on a 10-day basis, which you don't get that from this chart, but you get that from looking at the market health check that we spent some time on earlier. So as I go through this stack, anytime that I see one of the big broad indexes, like the S&P or XLK or the Euro-Asia blend, and I see that the entire market is in this tightly compressed range, then I know that if it does break out, it's going to pull along a lot of the underlying components. So tomorrow, in my view, could be a really strong breakout day because we're past the weekend noise cycle and we're poised at a critical state on a 10-day basis. And because of the lack of volatility, which we see the daily squeezes look very attractive. So I also noticed that UDOW, the triple DIA, is at 1.9. So all I need for tomorrow is DIA, the Qs, XLK, the S&P itself, and then I would think the Russell could really benefit. So I'll be looking at TNA, the triple leveraged, and also the TZA, the inverse triple leveraged off of IWM, which is the Russell 2000. So tomorrow feels like an index day to me. That could really be powerful. So that's how I use this particular report on the daily report to set up some opportunistic day trading. Now, in terms of hybrid trading, there's an opportunity. Now, Ken Hum asks a question, what about if there is a gap? Well, here's how I would answer that one. I know that a range stat from today's close to the upside is still from tomorrow's open is possible. So actually, the bigger the gap, the more I like the hybrid frog trade. So let's now link this. Here's a hybrid frog lesson. So one of the things that we know is that the bigger the gap, as the gap gets bigger, equals a bigger follow through. All right. So the larger the gap, the larger the follow through in either direction, right? So the way we measure that is if this was yesterday or today -1, and here's the close, then on tomorrow's open, wherever that opens, if there is a large gap up, let me change that out. So if this was the close, so there's our open, our high, and the low, and the close of the day. So if tomorrow it opened exactly where it closed, then there's no gap. But if it opens up here or down here, then that's the size of the gap. Now, the larger the gap, the larger the follow through there has typically been. So, what do we mean by the follow through? Well, if this is the open and this is the close, then the difference between the open and the close is the follow through. So if it, wherever it opens, if it closes exactly where it opened, then there was zero follow through. But it could also, if it opened here, it could close higher or it could close lower. So if it closes lower than it opened, that's a minus follow through. If it closed higher, it's a positive follow through. Now, one of the things we know from stats is that the larger the gap, the bigger the follow through. We just don't know which direction. It is the direction of the gap does not predict the direction of the follow through. Only the magnitude, only the size of the gap predicts the size of the follow through. And it's a pretty strong correlation. And why is that? Well, the bigger the gap, the more overnight news there was, and the more rebalancing there has to be done, and the greater the volatility the next day that has to be processed. And that generates short-term momentum. So when you have a large gap, it stands to reason that the follow-through is also going to be big. We just don't know the direction. So Ken Hum asks, what if there is a gap tomorrow? So we knew that there was a very tightly compressed doji today. It was only 0.42, 40% of the normal range of the S&P. And we said that if it breaks out from here, it could move approximately $4. Well, you could set an upside target of plus $4. What if it gaps? What we want to see is it opens inside the range and then breaks out. Well, what if it breaks out and gaps higher? What do we do then? Does that invalidate this trade? No, because wherever the gap opening was, so if there was the close and here was the gap up, when we put a hybrid frog box on this thing and it moves out, we measure the reasonable intraday move is still a plus range stat or a minus range stat. Because the gap this gap right here does not predict whether the big run is going to go up or the big run is going to go down. It's equally likely. So if we have a nice tight hybrid frog box on this, and the frog box in the S&P is 2.68, so if we took 1/4 of a frog box, which is about, call that to 60 cents, if we said from the open, if it moves 60 cents in this direction or 60 cents in this direction, then we would just buy it with a 60-cent trailing stop. This thing could still move $4 from the open. So if we give it 60 cents, this thing could still move $3.40 in our direction to a range stat move, which gives us 5.5 to 1 on a hybrid frog move to a range stat. But it could also just as quickly reverse. Well, so if we go up and it moves 60 cents and we get long and it starts to roll over, stop and reverse, and it could move $4 in that direction. So now we actually want to see a big, strong gap. We either want to have no gap or where it opens inside yesterday's range, and then we can play the breakout. So if it opens inside yesterday's range, a trivial gap, then we can just play the regular breakout from the high or the low of today and just trail it with 50 cents. But if it breaks outside of either the high or the low, so it's outside of today's range, then we think there's going to be an even greater likelihood of a wild move. And so now you want to trade it with a hybrid frog. and then quickly get your stop to no lose plus dinner for two, I might even use a 40 cent instead of a 60 cent so that I can get in sooner and get my risk out quicker. So I either want a really big gap or almost no gap. If it's no gap and it's inside yesterday's range, I play the breakout from the range. If it gaps outside of today's range, then I use a hybrid frog technique and then go in the direction of the breakout, but I am quick to get to no lose plus dinner for two and then stop and reverse. So I'm ready to play that in either direction. The gap does not scare me. The gap identifies the opportunity. So I'll be watching the futures carefully. If there's a big pre-market indicated move in the futures, then I'm really going to be ready for the hybrid frog. If there's no gap, I'm ready for the breakout from the daily range. All right. So that's going to be the way I trade that, with about a 40 cent risk on the S&P. Does that answer your question, Ken? Yeah. That's part of the day trade and the hybrid trading workshop right there. That'll probably be a lesson in the course that starts next week, because that's why I love this chart. And I love these things that are giving me indications of a really big move. This is the simplest way I know to get one-day pops. It's simple rules. These are targets that have become compressed on a daily basis. And the second criteria, they have a large potential intraday move compared to the size of the daily range. And so the risk calculations, we're either using the range risk or a full ATR or a quarter of an ATR. And I picked the one that's in the middle. A quarter of an ATR is $1.10. A full ATR is $4.39. Today's range risk was really close to just a quarter of an ATR compared to the full ATR. Okay. Just so you know that in the last 200 days, the biggest move in the S&P was $16. So imagine what would happen if we had a 50 cent risk and this thing moves $16 in a direction. That's a 30-to-1 explosive move. So range max just gives you a sense, especially in low volatility times, the latent power that's in the ocean and those unseen turbulent waves, deep underneath the surface of the water. Those tsunami waves that haven't emerged yet. That's the rumbling in the deep, right? That's what that range max tells you. Okay. So I wanted to spend some time on that one, because now this shows the relationship between the daily squeeze and this auto framer. So here's the case where the auto framer is showing us the S&P 500 was number 3 on the reward to risk ratio on a swing trade at 3.6 to 1. So that's in a critical state on a swing, and it's also the number 1 on the daily pop. Let me show you another one that's interesting. Intel is number 2 on the auto framer at 4.3 to 1. It's even better than the S&P. And Intel is at 1.9 to 1 on the daily pop. So this is ready to break out as a swing trade and as a one-day pop. So why is that interesting? Well, if you're in the hybrid course, what this leads you to is a whole series of trades that could happen in Intel. Watch what could happen with Intel. So Intel is postured for 4.3 to 1 on a test of the 10-day high. So it's a good distance away from the 10-day high. And it was squeezed on a daily chart and gives you 1.9 to 1. So this could just give you a nice one-day move of basically 2 to 1 using a full range risk. And it could give you a couple more days of follow-through moves just to get back to the 10-day high. That's very cool. So this could be the start of 1, 2, 3 days in a row. And then if it starts rolling over at a 10-day high, you just cash it and you say, man, I just had a combination of a nice intraday pop, which funded the swing trade risk to go up and test the 10-day high. So when you see symbols that are on both of those charts, you have an opportunity to do something very interesting from a hybrid trading standpoint. Okay. And the framing data for the daily charts are already given to you when you look at the you go back to the auto framer. This framing data is already given you what all those key price levels are. And you like Intel, it's only $47 a share. And the range risk today was 80 cents, or call it 90 cents. Call it $1, right? So that's today's trading lesson. Shift back to the MACD histogram and the 4 seasons. We have Intel in the fall, meaning that it has pulled back and is offering an opportunity. That's good. We like that. We see, where's the S&P? The S&P is in the fall, so that has some room to run. Like that. Here's the strength in technology. XLQ and XLK are in great shape there. There's Apple in the summer leading the way, and Microsoft, on the other hand, is deep in the winter. So there's a recovery trade in Microsoft, Walmart, and Disney are all postured for some nice catch-up trades. So I like those. So there's something for all seasons tomorrow. The multi-time frame NDX summary to get us done for today. Let me let that come up on your screen. Big moves in tech and the Dow. Japan and real estate were really big today. The S&P had a nice 2-day breakout because of the gap. Only energy really suffered today. And in the Dow, Disney, Apple, United Health, big strength there. And I like Microsoft and Coke. That's the old school, consumer leaders right there talking to you. Apple, Disney, Microsoft, and Coke. All we need there is McDonald's. And McDonald's had a pretty good day today. There's your big 5. Yeah, make it 6. And so selling Walmart. This is the American consumer who's getting his extra $600 check. And maybe they'll squeeze 2,000 grand. If the Dems are smart and competent, which is, they've 0 for 2 so far, they will put the Republican Senate to the test to make them decline to give people $2,000 just prior to the Georgia senatorial election. You think they can suffer? If the Dems are smart, they'll get that done. And there's no lose for the Democrats to do that. For a mere price of $1,400, which they're mean testing anyway, they could really put the Republicans behind the 8 ball. So we'll see how that shakes out. But that's all good for the consumer. So I don't see how they fail on that one. All right, that's everything I want to cover on the daily report. Let's see if we're going to try to review a couple trading charts from today. See if that wants to cooperate. And again, we'll get this recorded even if it doesn't. So here's some trades from today. This was Virgin Galactic. This is that speculative tech space company from Richard Branson. So this one started off, I liked the gap up and starting to roll. It caught me just in time. It gapped up, sold off, held, and started to move out just in time for me to get it as it crossed the VWAP. I took about half a execution R there at the rising PSAR. When it broke below yesterday's close and yesterday's Bollinger Band mean, I got short here. I consider that like a collapsing dragon. Added a second position here, then took the sniper exit at the PSAR for a good trade. I let it find support in here, and then I bought a COTA 2, which was a low, a higher low with an RLXD, and shortly thereafter it exited, and then I was done with Virgin Galactic. It was hard to borrow their shares this first time, and I couldn't get them. I couldn't borrow them later, so that was as much as I could get on that one. But I was happy with the first trade. So that was a case of not staying wrong too long. So this was U.S. Steel. It started with a gap up, immediately sold off sharply, found support about 10 minutes in. I bought it as it crossed the VWAP with a stop here just below the dragon. I added a second position as it was crossing from the opening, which ended up taking the sniper exit. I was not prepared to take the short trade, and I was waiting for it to give me a COTA 2, but it kept making lower lows. By this time, I really was disappointed with myself. But then I got the supported spring crossing here, which then scratched, and then I re-entered and basically scratched and was kind of disappointed with it, and then completely missed the short, and I just stayed away from it as it got in towards the lunchtime. I just didn't feel the mojo in U.S. Steel. This one actually returned to the VWAP, so I would have been I'd have been happy to have gotten the supported spring crossing there. I just didn't have the will. This was McDonald's. So I liked the gap up. It held support. I bought it as it broke out above the, made a new high of the day, and then it immediately sold off. Took a fractional loss. I missed the short. This was a supported spring crossing, though. Here's your winter. There's your RL10 holding support above yesterday's VWAP, above today's rising RL270. Winter turns to spring. There's the PSAR flip. There's a really tight stop in there. That's about a 50-cent risk. Let me draw that risk for you. This was a pretty good trade today. Probably my best one. So here's the risk box, like 40 cents. It crossed the VWAP. I thought about adding. I wanted to see it get above the RL10. It did, and then when it broke above the Z3, I finally added here. I felt I was late getting into that one. I took half the position here at the sniper, and then the second half at the managerial exit, which was the same exit. So that was a pretty good trade from 212.60 to 214.60. So that was a $2 gain on the first position on a 40-cent risk. So that's 5R. And then this one was about 2R. So that's about 7 execution Rs there on McDonald's on the long side. And that's why I like them tomorrow too. This one is the financial sector. This one also gapped up, sold off. This felt like a this was an RLXD short. I thought it was going to come back to yesterday's VWAP, which was way down here. I was looking for this move down to the RL270. But after I got short, it gave me the RL10, and then I took a 1, 2, 3 exit for a fractional loss. I then took the supported spring crossing. I used the low of the RL10 for my risk, and then when the PSAR flipped, I was already in the money. And then I added a second position as it was testing this Z3, and it broke above today's high. So the second position in the usual spot, and then just taking the PSAR sniper exit up in here. I was trailing it with the Bollinger Band main here. It just felt like it had peaked, and we were getting in late in the morning, so I wanted to get paid. That was probably another 4 to 5 arm. This one was in Mexico. I was just swinging and missing all over the place today. It was a big gap up, harsh sell off. I shorted it below yesterday's support level. The short worked. I took a 1, 2, 3 exit, then bought the supported spring crossing with a stop here at the Dragon. Cashed the sniper exit, re-entered, fractional loss, tried to get short, scratch, tried to go long, fractional loss. You just keep firing. Here's a collapsing Dragon and a Z3 breakdown. That one paid off. Took the RLXD exit, got short, scratched, took a break because I was feeding the broker at that point. Here's a COTA 2, so here's a low, a higher low, supported spring crossing, fractional loss. I was getting a little worn out by this point. I didn't take the COTA 2. I took the next COTA 2. That one paid with a sniper, and I just felt like that was about as good as I could do on Mexico today. So that was I spent a lot more energy on Mexico than the other ones. The ones that were simple worked better. And maybe I should have spent my time on the things that were working in an orderly fashion. I just had, I had a feel for Mexico that just, I was probably a C+ trader on Mexico today. But the other, I don't mind taking these false starts. There's 3 false starts in a row. And then they all look the same leaving the station, and then the follow through works when it works. So you just got to, you got to ante up and go for it. And then you just can't stay wrong too long. Like if I had really believed in this one, I'd have gotten smashed on this trade. So you can't stay wrong too long. Can't stay wrong too long on this one. Didn't stay wrong too long on that one. So just that's the learning point for today. Was if they don't work right away, then maybe they're not working. And you didn't believe in them to begin with. So just it should be easier to get out than it was to get in. I find it hard to get in, easy to get out. So that's everything I got for you today. We'll get this published and posted and hung in the usual spot.